The Peter Schiff Show.
Well, earlier today, they released the Federal Open Market Committee, FOMC's minutes. And of course, everybody expected those minutes to reflect the intention of the FOMC to raise interest rates in December, because everybody is convinced it's a 90+% probability that that is what they are going to do. And of course, like beauty, I guess the Fed minutes are in the eye of the beholder, because all of the comments that I heard following the release of those minutes were basically, yep, this is it. A increase in December is a sure thing. In fact, I was watching on CNBC. And by the way, CNBC actually had me on television today. I was on Fast Money, 5 o'clock in the U.S., the first time all year that CNBC has had me on. Now, I have been on their website, CNBC.com, and I've been on CNBC Europe and CNBC Asia many times. In fact, we post those shows up on my YouTube channel, on my Facebook channel, so you can certainly see the clips. But this is the first time they've had me on in the United States. So first time all year. It's November. I almost made it for the entire year without being on. So thankfully to the producers at Fast Money, they're the only producers over there that have the guts to have Peter Schiff on their air. But I came on to discuss these minutes. In any event, so I'm watching earlier on CNBC. Steve Leisman is talking to some guy, and the conclusion is, oh yeah, the Fed's going to move. It's a sure thing. It doesn't matter what the data is. The guy said even if the November jobs number is really weak, they got to move. And I'm thinking, what is this guy on? I mean, how is he coming to this conclusion based on these minutes, right? If you go and look at the exact words in these minutes, kind of Greg Brady style, right? The exact words. What did they read, right? The minutes show that most of the FOMC members, not all, most of them. So some of them don't share this opinion. It's still divided. But most believe that the conditions will be right for a December rate hike. But they're not really sure. They haven't made up their mind. And it all depends on the data that comes out between the meeting and the December meeting, right? That's what they said. Well, does that sound like a guarantee? Most of us think we should raise. Well, that means some of them think that no matter what the data is, we still shouldn't go. You still got plenty of people on the Fed that want no rate hike, right? So it's not a unanimous deal. But even the people who are leaning towards a rate hike, they don't know yet. They haven't made up their mind. They want to see more data. They're not sure. And of course, even if conditions are appropriate for a rate hike, that doesn't mean that rates will be hiked, right? They can still decide, yes, it's appropriate, but no, we're not going to do it for whatever reason. And they can just say, well, it depends on the data. And of course, if it really depended on the data, and I'm going to get into some of the data again that's come out so far this week, it's all been bad. The data has been consistently bad. So if they're really data dependent, they shouldn't be raising rates. The only reason they may raise rates is because they feel they have to, because they're worried that the market might begin to get suspicious of the game they're playing if they don't move, right? And I've even heard people from the Fed say this, that they want to raise rates just to show they can, just to show that they're confident in the economy, even if they're not. So it's all make-believe. It's like, hey, even though we know the economy is lousy, let's raise rates 1/4 point because that'll show how much confidence we have. And in fact, what they even said in these minutes is that what's important is not when they do the first hike, but when they do the next one and how many hikes they have. What the Fed said is that the sooner they start hiking, the sooner they can stop, right? And the lower rates are going to be when they stop. And a lot of people are speculating it's going to be one and done or two and done. I heard when I was on CNBC today, one of the guys that was on there said he thinks they're going to raise by 1/4 point in December, and then the next 1/4 point won't happen for another year until December 2016. I mean, is that what the Fed has got up its sleeve? I mean, but the thing is, if they really do that, if they hike interest rates and then say, okay, we're done, this is going to result in a sell-off in the dollar and a rally in gold. And I think it will, it'll be a much bigger move because what's going to happen then is the data is going to get weak because even though the Fed promises that it's not going to hike rates much more, they would have already hiked them. Meanwhile, the economy is already decelerating. And if they pretend that there's more rate hikes coming, even if they're coming later rather than sooner, the market is still going to try to factor that in. But we already have this decelerating economy. The retail numbers, and I talked about that last week, but we got more retailers that have come out this week and posted much weaker than expected sales. Urban Outfitters had a big drop in their sales. I mean, Dick's Sporting Goods. I mean, we had a bunch that came out last week, but all of this evidence should weigh on the Fed and should reveal that the economy is a lot weaker than people think. Look, if we're creating all these jobs, why don't the people who have new jobs need a new wardrobe, right? They got a new job. Don't they want to get some new clothes to show up at work? The fact that people aren't buying new clothes means maybe A, they're not getting jobs, or B, the jobs pay so little that they can't afford any new clothes. Or maybe the type of jobs they have, it doesn't really matter what they wear because they're doing such menial type jobs that they could just wear, jeans and a t-shirt or something like that. They don't even need any nice work clothes. But of course, when the markets rallied today, the interpretation is, well, see, the Fed says they're going to raise rates and the markets don't care. See, I really think that the minutes, again, don't confirm that the Fed is about to raise rates. But what the markets are also hearing is that even if there is a rate hike, they shouldn't worry because it's not going to be followed up by a tightening cycle. But it's a tightening cycle that is really baked into the dollar. The dollar has rallied for years, not based on a one-and-done quarter-point hike, but based on a normalization of rates, maybe not all the way back to their historic norms, but certainly 2 or 3%. They're not thinking that the Fed's going to raise from 0 to 0.25 or 0.5 and call it a day, or that's it, right? The gold market is sold off dramatically based on tight monetary policy. 1/4 point is not tight monetary policy. I mean, it's not as loose as 0, but it's still not tight. It's still nothing that is going to stop a bull market in the precious metals and gold from resuming. One of the things that really could prove another excuse for the Fed is the unfortunate terrorist attacks that took place over the weekend in Paris. And, initially, when the markets opened for trading in Europe, first in Asia and then in Europe Monday morning, and of course that's at night for us. But there was an initial sell-off because normally you would think, okay, a terrorist attack, this is bad for the economy, and now the government's going to be spending more money unnecessarily in most cases. They always overreact the way we did following September 11th. But if the French are going to spend more money on security, if they're going to spend more money on military expenditures, and obviously if there's some disruption to tourism as a result of this, I mean, certainly this event could psychologically have an impact on the economy and financially have an impact on the economy. So the initial reaction is, oh, this is bad news. Let's sell stocks. But traders quickly realized that all bad news is good news, including a terrorist attack. Because what does a terrorist attack mean financially? I'm not talking about or making little of the fact that people lost their lives. But what does it mean? It means more money printing. It means that the ECB is going to be even easier in the aftermath of the terrorist attack than they were going to be had the terrorists not attacked. So that means more QE. And so that's good for the market. So the market rallied. And it's good for our market because if the ECB is doing more QE, then the Fed could keep interest rates lower for longer, right? The Fed can use this as an excuse not to raise rates, but still pretend that they're about to do it. And by the way, over the same weekend, we found out that Japan is back in recession again, right? Who, other than Paul Krugman, didn't see that one coming, right? So they're back in recession. So, hey, more QE in Japan. So all this bad news is good news, and that is what is propping up the market. One thing I wanted to mention about the terrorist attacks is I haven't actually commented on them, but this is going to be another rallying cry, I'm sure, in the United States. Yes, we need more gun control. See, this is terrible because those terrorists had guns and all these people were killed because of guns, and therefore we need more gun control. See, but the problem is, Paris has some of the strictest gun control laws in the world. I mean, France is very strict, but Paris is even stricter than the rest of the country. So they can't really, have any more gun control than they already have. In fact, the real problem in the terrorist attacks, particularly in that concert hall, the problem wasn't too many guns, but too few guns. You see, gun control made sure that not a single person at that concert had a weapon. They were all defenseless in the face of these terrorists. I'm not sure how many gunmen were there. There were 2 or 3 people there in a concert hall that had hundreds of people. I don't know whether 1,000 people were in there. I'm not sure how many. I mean, I know over 100 were murdered, but I mean, most people escaped. But the problem was that's all they could do, run. Some of them played dead. But what they couldn't do was fight back because they were all defenseless thanks to gun control. These guys that were there, they had to reload many times, right? And how could they do that? Because no one had a gun, right? So they can carefully take aim and shoot defenseless, unarmed people one after another, no retaliation. Now, what would have happened if several of those concert goers had legal permits to carry concealed weapons and they had them on them? How many people would have died? I don't know, but not nearly 100. Because as soon as the terrorists opened fire, they would have been shot by people who were legally carrying handguns and who were trained and knew how to use them. And of course, the minute a few people fired, I mean, what are the terrorists going to do? They're going to have to run and take cover, even if they didn't get shot right away. And that's going to give the people who didn't have guns more time to get out of there. But no, they knew they could take their time. They were confident that nobody in that concert hall was going to have a weapon because they all abided by the law. The only ones that don't abide by the law are the criminals. And so the same thing is going to happen over here. And, I think one of the reasons, too, that these terrorist attacks, when they're with guns, get all this press is because the anti-gun lobby wants to use this because, the Russian plane that was downed a few weeks earlier, 230 people died there. I mean, that's a lot more than died in Paris, although we don't know. There's a lot of wounded people who may, in fact, die. Hopefully they'll pull through, but there's some seriously injured people. But the death toll is still not going to be as high as what was suffered by the Russians because there was a bomb in their plane. But for some reason, it doesn't seem as scary when a plane blows up as when somebody shoots a gun. But, you can't really do much. If somebody puts a bomb on a plane, that plane's going to explode and it's going down, right? There's nothing you can do about it. There was something that could have been done to limit the injury, or the deaths rather, from this terrorist attack, and that is to have law-abiding citizens carrying guns, because that would have made it a lot harder for the terrorists to do what they did, and the death toll would have been much lower. And so guns would have saved lives. They wouldn't have taken lives. The reason so many lives were taken is because so few law-abiding citizens, or in fact, not so few, no law-abiding citizens had any guns. And of course, the same thing happened at the various restaurants. Nobody was armed. I mean, they had to wait for the police to get there, but time the police are there, everybody's dead. That is the problem, especially in a venue as large as a concert hall. That was a gun-free zone, right? Which means, hey, if you're a terrorist, come on in, because all your victims are completely defenseless. But I want to get back to talk about the economy. But again, all of this is a problem in Europe. And again, the French are going to respond much the way we did. They're going to limit the rights of their citizens. They're going to make it harder for them to travel. They're going to spend more money. They've already retaliated. I'm sure they're going to create more problems than they solve. And all this is going to complicate things for the French economy, which means more money printing in Europe, which means more money printing in America. Hey, everything is great, right? This is what people are thinking. And in fact, when the Fed didn't raise rates in September, they cited concerns regarding what's happening overseas. Well, clearly they could have the same concerns now regarding the terrorist threat. And of course, the elevated threat that there may be another one. And maybe we're on higher alert. I mean, maybe the Fed wants to be a little cautious because, what if there's this terrorist attack here? Right? Well, we're going to need a lot of money printing then, right? I mean, God forbid the terrorists attack us, because, whenever anything bad happens, the central bankers feel obligated to do something, as if printing money actually makes the situation better. It doesn't, but that's what they think. And so that's the policy. Something bad happens, like a terrorist attack. Well, we got to do something about it. What can we do? Well, print money, QE, right? But let me go back to the economic data that has come out this week. Because again, if the Fed is data dependent, well, here's the data. We got the November Empire State Manufacturing survey that came out. It was supposed to be -5, right? It was supposed to improve from last month's -11.36. And it did improve to -10.74. It was a slight improvement. Nobody thought the index would be this low for that month, yet it came out very weak. And this is the fourth straight month in a row that it's been down. And in fact, I think it's down for 9 out of the last 10 months. And all of the components were very weak. I mean, this is the biggest losing streak for this index outside of a recession. So, maybe we're in a recession, and that's why we're getting readings consistent with a recession, or this recovery is so weak that it's like a recession, which is why I've said many, many times, right? If you think this recovery is bad, and it's the weakest recovery ever, the recovery is so weak that it feels like a recession. It looks like a recession, but supposedly it's a recovery. So if the recovery is this weak, imagine how weak the recession that follows this recovery is going to be. And in fact, the Fed doesn't want us to have to live it, right? Let alone imagine it. That's why they want to keep interest rates at zero. That's why I still think that the safest thing for the Fed to do, given the game they're playing, right, is to not raise rates again in December and keep pretending that they're going to. Because so far, so good. So far, it's working like a charm. Why take a risk of raising rates and upsetting this apple cart, especially when this economy is so weak? And if you simply nudge it a little bit, it's going to go over that cliff. Now, also yesterday, we got industrial production. Industrial production was supposed to rise by 0.1 because it was down 0.2 in September. So they were looking for a mild bounce back of up 0.1. No dice. Another decline of minus 0.2 in industrial production. So again, I mean, this is, some of the weakest numbers. Industrial production has dropped now. Yeah, this is the 9th monthly drop in the last 10 months. This is the weakest the index has been, industrial production, since January 2010. I mean, how many more signs of a recession does the Fed need? Again, if they're data dependent, the data would argue to not raise rates. But they don't want to admit that. Even today, we got housing starts numbers, and this was the weakest in 7 months. They were looking for 1.16 million. We got 1.06 million, 7-month low. And look, if housing starts are weakening now and rates are still at zero, what's going to happen to housing starts if rates go up? I mean, obviously, they're going to weaken even further, and that's the last thing the Fed wants. I got a comment, though, on the price of gold, which did hit a new, I think, 5 or 6 year low earlier this week. It managed to eke out a very small gain today. And in fact, one of the reasons I think that gold sold off was that it failed to rally on the terrorist attacks. I mean, the initial knee-jerk move, gold did manage like an $8 or $10 rise, but that wasn't big enough to show anything. And I think people took advantage of that rise to sell into it. And again, because the euro went down, the dollar went up, and it was the strong dollar that undermined gold. And that is the trade that's been going on for years. It's buy gold as a safe haven, or excuse me, buy the dollar as a safe haven. And if the dollar's a safe haven, then gold is left out in the cold, and people will short it. And that's what happened. Gold failed to rally in the wake of the terrorist attack, and so the shorts came back in. But everybody is piled short because they're all waiting for the Fed to hike rates. This is the most anticipated rate hike in the history of rate hikes. And again, one and done ain't going to cut it. the Fed is going to need to raise rates substantially to validate this move in gold and to validate this move in the dollar, but they can't, because they can't validate it, because any significant move up in rates would precipitate a financial crisis, which would precipitate a collapse in rates, more QE, which would mean gold's going to go up and the dollar's going to go down. So the currency markets and the gold market are preparing for something that cannot happen. But in any event, either the Fed is going to raise rates slightly in December and indicate that they're basically done, or that they're not going to move again for a long time, or they're not going to raise rates again, and the market is going to figure out that they're never going to do it. But either way, I do expect to see a reversal in the price of gold and the beginning of a new bull market, and of course also a new bear market in the dollar. And eventually, as the dollar turns around, and I believe consumer prices are going to start picking up, commodity prices will turn around, the CPI is going to go higher, it's going to go north of 2%, and no one's going to care. The Fed's not going to do anything about it because, as I said, we're already moving towards recession, right? Yes, the unemployment rate is still low, but so what, right? It's always low when the recessions begin. The unemployment rate starts to move up during the recession. And in fact, normally the unemployment rate maybe peaks at the end of the recession, right? It's not that employers are so smart and they anticipate a recession and they start laying people off to prepare for it. They get surprised by the recession. They're caught with their pants down. They have all their employees on board. All of a sudden there's a recession and they realize they have too many workers, and then the layoffs begin. Right. And then the recession gets worse because now the layoffs are picking up. It's not until the recession ends, right, that you start to see the unemployment rate come back down, because now people start to be confident in the economy again. They hire back more workers. I mean, the last couple of recessions started from levels of low unemployment. Look where the unemployment rate was in 2007 before the financial crisis. It was very low. It was around lower than it is now. In fact, the unemployment rate, and of course we had a much higher labor force participation rate back then. So you can't be basing it on just the unemployment rate. All of the forward-looking indicators are showing that the economy is decelerating rather rapidly, and I think that is going to continue regardless of whether or not the Fed hikes rates in December. But I think if they do hike rates, that process will take place a little more quickly than might otherwise have been the case. And so as inflation picks up and as the economy weakens, and the Fed now has to start talking about more quantitative easing, as they have to start talking about reducing rates again. And in fact, I believe if the Fed does raise rates in December, they are going to leave open the possibility of cutting them. Right? They're still going to be data dependent. And they're going to say, hey, we're flexible both ways, right? We're going to go up or down. Because when they do have to cut rates back to zero, they don't want to have backed themselves into a corner where they said they would never do it. They always want to leave themselves that out because they know they're going to have to take it eventually. And so they want to make sure they've laid the foundation to cover their butts. Hi, this is Peter Schiff, and long before foreign governments and hedge funds were buying gold by the ton, I urged my clients to put 5 to 10% of their portfolios into physical precious metals. Despite gold's massive rise over the last decade, I still think that a 5 to 10% allocation to gold and silver is a smart investment decision. But buyers have to beware. Big TV gold dealers push all sorts of coins that are poor investments. Bait and switch deals, price protection guarantees, leveraged gold accounts. These are just a few of the sleazy tactics used to swindle inexperienced gold buyers. My gold company is different. We never offer a coin or bar unless I consider it to be a good investment. I want my customers to be educated. That's why I'm offering you a free research report exposing the biggest scams and ripoffs in the industry. Download my report, Classic Gold Scams and How to Avoid Getting Ripped Off for free at goldscams.com. This report tells you everything you need to know about how to avoid losing thousands of dollars with scam gold dealers. It even tells you how to tell if a salesman is lying to you on the phone. This is a must-read for anyone considering a gold or silver investment. Download this free report today at goldscams.com. That's goldscams.com.